So our company is called Return on Change. We're in fact an investment platform online. I'll talk about it a little bit more later in the specifics. Talk about me just to make sure I'm not crazy. I am also a recovering investment banker. It sounds like it's a very popular job to have, to recover from investment banking. I also serve as the Executive Director of CF50, which is the first global think tank of crowdfunding leaders. Many of you may know, Eddie knows too. There's a lot of regulatory changes happening everywhere in the world at the same time. It only makes sense that we should be sharing ideas because they're all very different. So we'll go all the way back. So startups have amazing business ideas, but they can't get funding. And what happened was enter the Jobs Act. As we know, I'll talk about it very briefly. Title II lifted the ban on general solicitation and advertising and private placements of securities, and Title III permitted crowd investing. So crowdfunding as a concept, a startup needs funding. Before, people went to wealthy family and friends as a secondary step, which is very difficult to do at times if you didn't have wealthy friends and family. Now you can go straight to the crowd. Right now, a lot of entrepreneurs have already been using it, using perks and donations-based crowdfunding. And hopefully in the near future, we'll also have equity crowdfunding, well, securities crowdfunding rather. There's a secondary component actually in addition to the capital that we're finding very interesting research and results on, is that the crowd curation, crowd validation model actually works very well. We have yet to see the amount of due diligence that a crowd can do in terms of what it really means for the founders or the business model itself. But in Australia, for example, they've been doing it for many, many years. They've closed about 300 million in transactions on the ASOB, which is the Australian Small Businesses Offerings Board, and they've had 0 instances of fraud in the last 7 years. We also see it here in a lot of Kickstarter campaigns as well, where the crowd on Reddit, for example, curates information, and they've taken down many, many campaigns that were, well, it's not security, so it can't be fraudulent, but for anyway, fraudulent in nature, and they were immediately taken down thanks to crowd action. So it's a new source of previously inaccessible capital at all, and Stuart talked about this in the beginning. It was completely inaccessible. Whether you're using general solicitation or not, even friends and family, you probably broke the law if you've done a friends and family law because you didn't do it right. But now you can actually do it on the internet, which is a fantastic new tool for a lot of startup companies. So if you estimate the amount of savings in the United States, they estimate it to be about 6.6 trillion. And this is not investable capital. This is just in savings accounts. And even if you invested about 1% in all savings, so liquid assets right now, that's 66 billion, which is about 2.5 times more than what venture capitalists invested in 2012. So that's just the sheer size of the crowd. We're not even talking about how it's really going to work, how we're going to tap investable assets, right? This is just liquid cash that's sitting in accounts, not accruing anything for those who know where we are. So it's simple, right? There's just a new option of raising money. There's VCs, there's wealthy friends and family, and then there's online funding. The venture capital model is not going away anytime soon. I mean, there's a lot of hype in media and writing about how it's going to revolutionize, and VC markets will disappear, it'll dry up because you'll never have to go to them, and you'll always get a better deal from the crowd. Smart money managers, accredited investors, advisors will always be necessary. What we're doing is we're taking the inefficient components of capital raising and bringing it to technology. And the inefficient components were trying to find investors, trying to see if those investors were appropriate for you, and doing that in an efficient manner. If you think about a person that doesn't have any wealth and family living in Iowa trying to do a $500,000 round, can you imagine how difficult that is if you can't even do it in New York City? So there's a general shift to the crowd now. And what happens there is that the crowd is actually influencing which companies and industries proliferate. If you think about this concept, it hasn't been done in the last 80 years. It's an actual reverse IPO model where you're allowing the crowd to decide what kind of companies grow, and then later on when you can actually bring this to scale, what we estimate to happen is that institutions will get involved, in which case you can actually shift giant portfolios of risk to the institutions as opposed to the other way around, which we think can be very, very interesting. One of the things that I mentioned before about the crowd curation, crowd validation model, we've seen it work extremely well with products because you don't have the customer development cycle anymore. They've already told you I'm going to buy 10,000 of these units. You haven't even made it, and you can already take that off the table, which is huge. Secondly, there's also a shift from the tech domain to the industries that have been underserved by traditional VCs. To no fault of their own, the VC market was driven by certain things, life cycle of the fund, flip rates, what the investors' appetites were, and the tech industry offered it. And what happened was a lot of the other industries that needed a lot of support, life sciences, education, kind of fell by the wayside because they weren't generating the numbers, the return numbers that a lot of people needed to see. So what we've actually seen is that even if you look at donations or perks-based crowdfunding, it's actually not the perks that are the most active. It's the cost. It's why they want to invest in the company, which is going to be huge. The empathy component of crowd investing is going to be a huge thing that you will see, play a more critical role. And third, it's related to the second one. It's the impact becomes a very relevant investment criterion, right? So what does that mean, really? If you're a crowd investor that's looking to put $1,000 to work, I want to do 10 $100 investments, it's not going to be, is this going to generate 36% IRR in the next 18 months for me? It's going to be, is this relevant to me? Would I use this product? Does it affect my community? Or will it affect my future generations? Those are going to be the primary drivers when you're making an investment. Because there's not going to be a financial advisor sitting next to you saying, I think you should put $100 here, I think you should put $100 there. It's going to be all on you. Which is why the education component for crowd investment is so critical. We spend a lot of time doing it right now, but portals like ourselves are going to actually be required to provide the education component. It's not really optional. When you do come onto a portal and you want to invest in things, we have to provide a whole quiz. I mean, there's no such thing as a bright line test with the SEC, but we have to do our best to make sure that everybody understands the risks of investing in this. You might invest in it because it gives you the warm and fuzzy, like I said, but it might not be the best bet. And we need people to understand that when they're doing early stage startup investments. So democratizing startup finance, especially for us, everyday individuals are going to be empowered to invest in alternative assets. And for good reason. There was good reason to prevent the general crowd from investing in alternative assets. After the first dump, we saw the Great Depression, and after that we quickly locked it down. We haven't changed it in 80 years, unfortunately, while information and technology is changing around us at an increasing exponential pace. And what that also did was it created lower boundaries for information asymmetry, which we think is going to be one of the most powerful drivers for making this successful, is that 1,000 people looking at something and trying to find information on something, properly curated, is actually much more powerful than 3 people sitting in a room saying, is this a bet, is this a good bet, or is this a bad bet? What is to be determined is how we'll be able to intelligently digest that information to provide a sort of different kind of due diligence that we've never seen before. And it's also patient capital, because of the investment caps that were mentioned before from Stuart, it's not something that you put 90% of your 401k into, nor should you. It's a small asset class for you. It's a huge asset class if you put it into the crowd. But it's also patient. I mean, some people do it, some people don't, but you don't really go into your 401k and manage it on a weekly basis. It's a very similar concept when we're talking to potential crowd investors who are excited about getting involved with startup companies. Funny enough, a lot of them understand that it's not going to move for 5 years. They understand that it's not going to come until there's exit. They're not going to give them cookies. They're not going to give them T-shirts. They're actually waiting for a financial return. And people were very worried about that misunderstanding that there will be donations-based or perks-based and there will be equity-based. But funny enough, most of the crowd already knows what's happening. Once again, it speaks to the information asymmetry concept, where a lot of people are going out and finding out for themselves what's available to them. So we have technological disruption. So what are the pain points? I mean, we talked about this briefly before, but raising capital is hugely inefficient and time-consuming right now. It's very, very hard to do. Access to capital is heavily restricted by geography and your own personal networks, and that's almost 100% of the time. And deal flow access is limited in a similar fashion. If you're an investor, traditionally, investors invest regionally and in what they know and who they got introduced to. So community is very important there, but also increasing the community through the internet is going to be very, very important. So Finance 2.0 is what we like to call everything that's happening right now, thanks to the Jobs Act in the United States, in the UK, Australia, Italy did it as well. It's digitizing early stage finance and expediting the process for all parties. There was a kind of a misconception for a very long time that early stage finance couldn't be digitized. It was kind of one of the, I don't know if it was a misunderstanding or it's probably more related to the regulatory environment that we lived in. But now we're looking at it and saying, actually, you can't commoditize everything there, but there are certain things we can bring online and I can do for you. I mean, syndication of a early stage deal is something that's been unheard of unless the lead investor was doing it. But now what you're doing is you're allowing the issuer to syndicate their own deal through the internet. And it also enables greater visibility and reach for the startup offering. So if I'm an investor elsewhere, I can actually view this offering that might be very interesting to me, and I can get involved. And this is not just talking about Title III or crowdfunding. This is talking about Title II and Title III. They have very big similarities. It's just that Title III, it's a whole new asset class. It's for the retail investor, mom and pops, or whatever you want to call it. Title II is still restricted to accredited investors, but there's a huge market for accredited investors out there that haven't been tapped. There's about 1 million active angels in the United States and about between 8 and 9 accredited investors by the strict definition of the standard. And they don't know that this asset class exists because they weren't given deal flow. But what happens if we tap that now? So once again, shameless plug, Enter Return on Change. We're a investment platform that's targeting the high impact sectors that kind of fell by the wayside by the traditional investment regimes. The CleanTech, EdTech, life sciences, technology, and social ventures as well. Investing with purpose, like I said, this is very important to a lot of retail smaller investors that it has the potential for a profitable return, but also it makes sense to them. It makes sense in their overall scheme of things that this business would add value to my life. So what we do for startups, so this is our overall process. There's a single application process. We have partnerships with broker-dealers on the back end for deal closing, the underwriting activities that was talked about. Seamless sharing across the social media platforms to the extent that you are permitted to do so, obviously. And if you do that, there's a whole host of other things that you have to do. So we can talk about that later, but be careful if you do decide to use Title II. It is permitted, but the rules are still proposed. They haven't come out with the final regulations yet. And right now we're in the process of reading, Stuart didn't mention this, but 600 pages of Title III commentary that we're actively reading. Analytics for campaign tracking and development. This is basically very similar to the syndication model. We're developing algorithms and formulas in the back end to see what we can best do for an issuer to reach the right target, to sell it quickly. And lastly, obviously, the deal documentation generation is also in development. What we're seeing a trend toward is that we think for certain kinds of deals, you're going to see one set of term sheet now. Series Seed, if you've heard of it, Preferred Series Seed, kind of did a good job in going in that direction. But in order for online deals for under $1 million to make any sense, it's going to be one set of docs, all the right reps for the startup companies. I have no debt, I'm not going to jail, et cetera, et cetera, et cetera. And then the term sheet's just going to be is what it is. For investors, what we offer with our partners, some with in-house, some with our partners, like the background checks. We don't do in-house. We partner with a firm called CrowdCheck. They do background checks on all startup founders for a very low cost that used to be very expensive. Online deal sourcing, obviously. The ability to quickly create investment portfolios, because angel investing can't be a concentrated activity. You do need to create portfolios to have a reasonable expectation of return. Full transparency and accessible due diligence materials. So our startups actually go through a lot more rigorous than a lot of them are happy about, but we basically go through a cursory broker-dealer due diligence check. Disclosure-wise, this is what you would disclose to investors in a regulated environment, so we go through all that. And also, we are also targeting global impact investment opportunities. Fortunately, the money flows one way, where U.S. investors invest in other startups in the world. The other way, I think, is going to be a couple of years before we can make that efficient. Maybe the next regulatory regime will be, changes will be anti-money laws and KYC. So the old norm, I mean, for us, especially at Return on Change, it made sense when people made devices and businesses around creating social impact, around saying, I'm going to create value for the economy, which is why we like our startups in our sectors. So now the existing hierarchy for us, what we've seen is that profit and social impact. The social impact is a collateral outcome. But actually what we've seen a lot of with our new startups that are profitable is that they're one and the same. They don't see the real difference of creating value for economy or the society as something completely different than what they're trying to do as a business. And that's my cue. That's it.
Can you talk a little bit about how much traction you have? I mean, what kind of companies are listed on the platform? Have you actually raised funding? And also, are you planning to do crowdfunding as well?
Yes, we are.
Right now it's all accredited.
Yes, that's correct. Our intent was always to be a crowd investment platform. Things kind of took their course. Title II came out, then Title III came out, whatever it may be. We have about 24 million in pipeline right now of startup companies.
24 million of capital
raising issuances. About 1 million reserved. I can't talk about it in terms of per company because that's general solicitation.
That's allowed now.
But a lot of our clients are actually not using general solicitation. They're very concerned about the final rules, and they don't know what it's going to look like. Because the issue is, or the question rather, is if you use general solicitation and then later on you don't like the rules, like how much do you really have to scrap and start from? Because basically the way we look at it right now is if you use 506C, general solicitation, A, you can get in trouble with the states right now because it's a little murky as to what advertising really means. And B, it's if they, I doubt that they'll retroactively come after people, but once again, I'm not a lawyer. But if they implement something and you didn't comply with that, what could very well happen is you have to scrap all your commitments and start from scratch again. So what they'd rather do is they'd rather be in the 506B regime, and then later on when they see a little bit more movement of proposed rules, they'll do it. Yeah.
I have just a general question on like the structure of the crowdsourcing market. I mean, to me, it seems kind of like a dating site, and I mean, I see tons and tons of dating sites. I imagine, I don't know if this is true, but I imagine that sort of the guts behind a bunch of them are the same company, like maybe Match.com like rents out their servers and lets somebody come in and rebrand it as, you know, dating for whatever. Is that true in crowdsourcing? Like if I wanted to go start like crowdsourcing for atheists or crowdsourcing for people who love cats or something like that, could I just go to some company and say I have a website, you know, I have the URL and, you know, I'd like you to change things a little bit, but I just want to be up and running and have my own crowdsourcing site like straight away?
Absolutely. Crowdfunding, I have tons of friends who run white label solutions for crowdfunding. I think for crowd investing it's going to be very difficult because the entity generating it is itself a broker. It's itself a regulated entity. So there are some broker dealer shops, for example, that you know you hang your shingle and you can kind of commoditize that service. But for example, if we become a funding intermediary portal and then somebody wants to outsource our technology, that business technically has to be one of our businesses in order for it to be a regulated entity. So you can open up a crowdfunding site tomorrow if it's donations or perks based because it's not regulated. In the security space, I think you're going to see a little bit more scrutiny and specialization because there's a finite number of licenses that the SEC will give out, and they've said that.
You actually mentioned one thing that I was really interested in, which is your your investor analytics tools. I actually find that a lot of crowdfunding sites are very focused on the investor. The way you said issuer kind of was very interesting to me because I think a lot of startups should be much more focused on doing analytics and moving from like the sell to the just put my stuff out there kind of model. So I'm really curious if you could just talk more around like what you have in the way of issuer analytics tools on the site.
So what we're looking at right now is we're creating a kind of premium model so that issuers have the opportunity to use these syndications tools. And it's really going to revolve around region, activity, velocity of capital from a certain region. Obviously the sector focuses. Later on when we have more data, what we're hoping to build around is actually increase the efficacy of it, right? Not just say you can target 100 investors, but if you use this kind of tool, your closing rate, for example, is 98% or whatever it is. But there's a component, like you mentioned before, there's a component that can't be really brought into technology, which is that guy good for you? I know he's spending his money there, and if you ping him, he's probably going to cut you a check. but is he the best investor for you to have? And I think that's still going to remain like a non-commoditized service. For us, it's really right now, we're only tackling one thing at a time, and one is issuer, syndication efficiency. I think is going to be the most important thing, at least in the near future, because what we're really interested about is new investor behavior. We're not really interested in like angel investor behavior, because I can call them and ask them, what do you do? Where do you cut a check? It's pretty much in their thesis. But the new accredited investor market, as well as the crowd market, we're very, very interested in, which is why we're actually getting the crowd involved before crowd investment is permitted. We have a crowd curation model right now, where actually offerings can't go live until your business model is voted into existence. So your business model goes up, you say, I'm the founder, but there's no offering of securities or investment interest. You have to get a sufficient number of votes where people are like, this is a cool idea. And then once that happens, your offering goes live, and then you have to go through the secondary procedure of getting your investments circled.
And you're tracking who liked the ideas.
Exactly. Yeah.
Thank you very much. Thank you very much.